According to the question, we have to compile two types of profit and loss statements or income statements here. And the first question is to prepare forecast income statement using marginal costing for both quarters. And we start as always with sales amount. Sales for the period equals the amount of units sold, 60,000 units, multiplied by the selling price, which is 45, unchanged for the whole period. And eventually the total amount of sales equals, I will change the color for the convenience, the total amount of sales equals 2,700,000. I will use thousands here for convenience, and all amounts are in dollars. So sales is 2,700,000. Then we have to calculate cost of goods sold using marginal approach. So the first thing, cost of goods sold. The first thing we have to consider opening stock, which is 0 here, plus production. And production in dollars could be calculated using the amount of goods produced, 70,000. I'm sorry, I'm mistaken there. 70,000 multiplied by total variable cost, which should be considered. And total variable cost is compiled out of direct materials, 10 per unit, plus direct labor, 4 per unit, plus variable overheads, 2.5. So 16.5 is the total amount of variable cost per unit. And if we multiply it by 70,000 units produced, we can easily calculate the total cost of production, 1,155,000. So here in production line, we have to have $1,155 of production costs. Then we have to consider closing stock using marginal approach, and closing stock could be calculated as, I will a little bit minimize it here, and closing stock would be the company sold 60,000 and produces 70,000. It means that 10,000 are still at the warehouse of the company, and we have to value it at 16.5 per unit, as we just calculated. So closing stock would be 165,000, and it should be deducted for the purposes of cost of sales calculation using marginal approach. So we have to deduct 165 in order to calculate cost of sales using marginal approach. I will add here marginal word in order to state the method we used, and we have to deduct 990 out of sales in order to calculate manufacturing contribution. Sales less cost of sales. Sales less cost of sales gives us manufacturing contribution, which is 1,710,000. And then we have to deduct variable costs, variable selling costs in order to calculate total contribution. Variable selling costs could be calculated as, I will use green, 60,000 units sold multiplied by $1.50 of variable costs per unit. Eventually, it gives us $90,000 of selling variable costs. And if we deduct that amount out of the manufacturing contribution, we receive total contribution per quarter. That would be 1,620,000. And then we have to deduct fixed costs, both production and selling, in order to calculate the net profit for the first quarter. Fixed cost production. In the wording, we have $400,000 of fixed production overheads, but they're budgeted for the whole year. So we have to take only 1/4 of that amount. So we have to deduct 100,000 of fixed production costs, and fixed costs selling are represented by the 80,000 per annum. That means that only 20 would be spent during 1 month. And eventually net profit could be calculated as 1.5 million. Great. This is the result for the first quarter using marginal cost approach. The next step is to calculate sales, cost of sales, contribution and profit for the second quarter. And now we have to consider the amount of goods sold during the second quarter. This is 90,000 units, which should be multiplied by the selling price of 45, and the total sales would be $4,050,000. So here we would have 4,050,000 as sales. And cost of sales using marginal approach could be calculated. I will highlight the line. We have to fill in subsequently that one. So now we are calculating cost of sales using the special technical lines. So opening stock now should be moved from here to here. So closing stock of the previous quarter eventually would be the opening stock of the current quarter. So the opening stock is 165,000. Then we have to consider production. The company produces 100 units, 100,000 units in the second quarter, and the variable costs wouldn't change, the same 16.5, and eventually that gives us $1,650,000 of production costs. So we have to add that amount here, 1,650, and then we have to consider closing stock. And closing stock would be, there should be some math. I will use orange color because I will calculate units. So the company had 10,000 units on stock. Then the company produces 100,000 units and sells 90,000 units. Eventually, at the premises of the company, 20,000 units are still presented. So we have to value closing stock as 20,000 units multiplied by 16.5. 16.5. And 16.5 is the cost of production 1 unit if we consider only marginal costs, only variable costs. That means that closing stock would be valued as 180, no, it's impossible, 330,000 dollars. And now we can calculate cost of goods sold using marginal approach and fill in that pink line I've just highlighted. So we have to add to sum up, we have to sum up opening stock 165, 1,650,000 of production costs and deduct closing stock of 330. Cost of goods sold equals 1,485,000. And if we deduct that amount out of sales, we receive contribution, manufacturing contribution, which equals 2,565,000. Then we have to consider variable selling costs. And now we have to multiply units sold, 90,000, by the $1.50, $1.50, which are variable selling costs. Total amount would be 135,000. And now we can calculate total contribution. Total contribution equals 2,430,000. And now we have to deduct the same amounts of fixed costs used in production, spent for production purposes per 1 quarter, fixed selling costs per 1 quarter, and eventually net profit for the company for the second quarter would be 2,310,000. I've calculated it without calculator. Maybe I'm wrong. I don't know. So basically, we have two profit and loss statements for the first and the second quarter using marginal costing. Before we would start compiling income statements using absorption costing, we have to talk a little bit about a normal level of production which is stated in that problem. So the point B implies compilation of absorption income statement. The normal level of production here for the year equals 320,000 units. That means that per 1 quarter, company produces 80,000 units. And when we talk about absorption costing, or full costing, we talk about inclusion of all the costs, both variable and fixed, into the cost of each unit produced. And before the company starts business period, before the company starts production period, the company calculates so-called absorption rate. Absorption rate budgeted basing on the budgeted amounts of units to be produced and costs to be incurred. Fixed cost, the total amount, should be divided by the number of units. And here we will receive, if we divide $400,000 by the total amount of units to be produced per annum, 320,000 units, it gives us $1.25 per each unit to be produced, or fixed cost to be included. For the quarter also, so if we take the 100,000 of fixed costs in dollars per 1 quarter and divide it by the number of units to be produced in 1 quarter, which is 80,000, we receive the same amount. So we will use that amount, $1.25, as a fixed cost per unit in order to calculate full cost. And now we can start to compile income statement under absorption costing. We we'll use the same format. So first quarter, all amounts are in $1,000. Second quarter, all amounts are in $1,000. And the first line would be sales. And by the way, sales would be the same. So I can barely copy it from the previous solution because the amount of sales, which is quantity multiplied by the selling price, won't be changed no matter which method of valuation of production and closing stock we use. So I will use the same amount of sales, which equals 2,700,000 for the first quarter and 4,050,000 for the second quarter. And now we have to calculate cost of goods sold. The same logic, the same formula we have to use. Opening stock plus production costs less closing stock. That amount should be used in order to calculate cost of goods sold. So opening stock for the first quarter, for the first day of the first quarter is 0. Production cost should be valued as 70,000 units. I'll write it down in green as technical supporting calculation. 70,000 units multiplied by the cost of production. And we used only marginal cost. In the previous method, it was 10 for materials, 4 for labor, 2.5 for variable overheads. And now we have to add 1.25 as fixed overhead absorption rate we have just calculated. And using that calculations, we will receive the cost of production, which is equal in dollars to 1,242.5, if I'm not mistaken. Closing stock should be valued using the same calculation. By the way, that amount would be $17.75 per unit. So we have to multiply 10,000 units left at warehouse by 17.75, which is the cost of production of one unit using full cost. And we have to write it write down it here in order to deduct it from production cost for the purposes of calculation of cost of goods sold. So cost of goods sold equals, for the first quarter using full costing method, 1,065,000. And now we can calculate gross profit for that particular problem. Gross profit would be here. And the amount of gross profit equals 1,635,000. I will check myself using the calculator because it would be not the first mistake. Yes, so the correct answer is 1,635,000. Then we have to consider the most difficult and the most important line here, over or under absorption. When we were calculating overhead allocation rate here, we were talking about normal level of production, 80,000 units per quarter. And in the first quarter, the company plans to produce only 700 units. That means that the company underproduces 10,000 units. And 10,000 units will never have that small portion of fixed overheads within. It means that that portion of overheads, $1.25 multiplied by the number of units underproduced, will never appear in profit and loss statement under production costs. So we have to deduct it. I will change the color and use a red to deduct it under absorbed I just can't remember the words принудительно in English. So we have to use it to deduct it принудительно from profit and loss statement. It would be 10,000 units of underproduction multiplied by fixed overhead absorption rate, which is $1.25. And that amount, $12.5 thousand, should be deducted. Then I will use normal color and deduct selling costs. Selling costs for first quarter, variable and fixed portion. Variable cost would be calculated as we just calculated before, 60,000 units sold, not produced, but sold here, multiplied by $1.50 gives us $90,000 and $20,000 of fixed cost per quarter, because per annum selling cost amount equals $100. So now we can calculate net profit under a marginal approach, and eventually all the amounts calculated gives us $1,512,500 of net profit. As for the second quarter, we'll be doing the same, and I will remind you that closing stock of the previous quarter eventually would be the opening stock of the next quarter. So we have to write down here 177.5 thousand as opening stock. For the as for production, we have to evaluate production multiplying 100,000 units produced by $17.75 we have just calculated as the cost of unit produced using full cost. So the total cost of production would be $1,775,000, and then we have to deduct closing stock, and closing stock should be valued using the same formula. The company had 10,000 units at the warehouse. I will use orange. Then produces 100 units, and 90,000 units were sold. Eventually, the company has 20,000 units at warehouse, and we have to value it at 17.75. So 17.75 multiplied by the 20,000 units gives us 355 as valuation of closing stock. And we can calculate cost of goods sold. So we have to sum up opening stock, cost of production, and deduct closing stock. Cost of sales would be $1,597.5 thousand, and gross profit would be 2 millions. I will change the color. $2,455,500. And for the second quarter, we have also to consider over or under absorption. And since in the second quarter the company produces 10,000 units more, it will happen that the company will have over absorption of fixed overhead in its profit and loss statement, because each excessively produced unit brings a small portion of fixed overheads, 1.25, but actually the actual amount of overheads which should be spent is only 80. And now we have to add back to recover the excessively deducted fixed overheads, because the company overproduced in that month, to add it back to the profit and loss statement. So we have to multiply 20,000 units of overproduction by the fixed overhead allocation rate, and the amount which should be added back, I will write down the sign plus, would be $25,000, which should be recovered in profit and loss statement. And then we have to deduct variable costs selling cost, both variable and fixed portion. Variable costs should be calculated as 90,000 of units sold multiplied by $1.50. Eventually, it would be $135,000. I'll use the eraser here because it can mislead someone. So $135,000 and fixed portion, which is the same, 20,000. Net profit for the second quarter under full costing now could be calculated. This is 2,452,500 plus over absorption of 25 and less selling cost, total selling costs, an amount 155. $2,322,500. But the last step is profit reconciliation. So we have to explain why profits under marginal costing and absorption costing differ. So we have to take the net profit calculated under marginal costing. I will copy the amounts, put it here. So these are profits under marginal costing. Net profit marginal. Then I have to copy profit under absorption costing and place it here. Oi. Sorry. Копировать. And place it here. And I will state that we use absorption. I'll change color. Absorption of full costing. And now we have to explain why profits differ. So, in order to explain why for the first quarter the company has 1.5 million under marginal costing and 1,512,500 of profit under absorption costing. The question is what was the amount of fixed cost expensed during the period? Under marginal costing, the company deducts the bulk amount of fixed costs from income statement in the period expenses were incurred. So it happens so that in the closing stock of 10,000 units left at the premises of the company at the end of the quarter, still kept $1.25 of fixed costs under absorption costing. That amount of fixed costs were never expensed. That means that if we add back that valuation of fixed cost not expensed during the period, we eventually would receive the same profit as under absorption. I'd better use the same format of amounts, I believe. So here should be 12.5. So if we add back that fixed cost deducted under marginal costing, we receive the same profit. What for second quarter? In second quarter, that amount of 12.5 would be expensed. So we have to deduct 10,000 units multiplied by 1.25. So that amount should be deduct $12,500 from the profit under marginal costing, and we have to add back 20,000 units multiplied by 1.25, which is eventually closing stock for the second quarter. And in closing stock for the second quarter are still kept that small portions of fixed overhead in each and every amount which are still kept at the warehouse. So that would be 25,000. And if we deduct from the cost and the marginal, from the profit and the marginal costing, the fixed cost of the previous period which were expensed in the current period, and then add back costs which were deducted under marginal approach but still kept the warehouse as a balance sheet asset, we receive the same profit which was calculated under absorption costing. So this is the basic reconciliation. And as you can see that over or under absorption lines have no effect on that reconciliation.